When the whole world stops to watch football, does the stock market celebrate or suffer? The FIFA World Cup is not just a sports tournament. It is one of the largest global economic events in history. In today's video, we will explore how the World Cup impacts the United States stock market, which sectors benefit the most, which sectors face losses, short-term versus long-term market effects, and most importantly, what investors should learn from it. Let's break it down. Section 1. Why the World Cup matters to financial markets. The FIFA World Cup attracts billions of viewers worldwide, massive corporate sponsorships, global advertising budgets worth billions of dollars. Whenever consumer attention shifts at this scale, spending behavior changes, productivity changes, market sentiment changes, and that is exactly where the stock market feels the impact. Section 2. Positive impact on the U.S. stock market. Key Cap 1 media and broadcasting companies. The biggest winners during the World Cup are television networks, streaming platforms, sports media companies. Higher viewership leads to higher advertising revenue, better quarterly earnings, short-term stock price momentum. Investors often anticipate this and position early. Key Cap 2 advertising and marketing industry. Global brands increase spending aggressively during the World Cup. This benefits advertising agencies, digital marketing firms, data and analytics companies. Why? Because brands fight for attention when billions of eyes are watching. This surge in ad spending often reflects positively in earnings reports. Key Cap 3 consumer goods and retail sector. Match days drive consumption, snacks and beverages, fast food and alcohol, sports merchandise and apparel. In the U.S., retail sales often spike temporarily. Consumer goods companies see higher volumes. This creates short-term bullish sentiment in these stocks. Key Cap 4 travel, hospitality and entertainment. When football fever rises, bars, restaurants, and hotels see higher footfall. Airlines and travel platforms benefit from fan travel. Event-based local businesses grow. Even if the World Cup is hosted outside the U.S., fan tourism and viewing events still boost this sector. Key Cap 5 investor psychology and market mood. Sports influence emotions. When excitement is high, investors feel optimistic. Risk appetite increases. Trading volumes often rise. Positive emotions can temporarily support market momentum. Section 3. Negative impact on the U.S. stock market. Key Cap 1 productivity loss, the hidden cost. Millions of people watch matches during work hours, follow live updates instead of focusing on tasks. This results in lower workplace productivity, slower business output, reduced efficiency in certain sectors. Over time, this can slightly drag economic performance. Key Cap 2 lower trading volumes during matches. During major games, traders pause activity. Market participation drops. Volatility decreases temporarily. This creates slower price movement, less liquidity in certain stocks. Professional traders are very aware of these patterns. Key Cap 3 consumer spending shift, not growth. The World Cup does not always increase spending. It often redirects spending. For example, money spent on entertainment replaces spending elsewhere. Luxury, education, or long-term investments may slow. Some sectors lose demand while others gain. Key Cap 4 short-term hype, weak long-term impact. The World Cup is a temporary event. Once it ends, advertising budgets normalize. Consumer excitement fades. Stock prices often correct. Investors who buy purely on hype may face losses afterward. Key Cap 5 market overreaction risk. Markets sometimes overprice media companies, consumer stocks, event-linked businesses. When expectations fail to meet reality, stocks correct sharply. This hurts short-term traders who enter too late. Section 4. Short-term versus long-term impact. Short-term, increased volatility, sector-specific rallies, emotion-driven trading. Long-term, minimal structural impact. Fundamentals dominate again. Earnings and economic data regain importance. The World Cup influences sentiment, not the core economy. Section 5. What investors should learn. Key takeaways. Sports events create opportunities, not guarantees. Focus on fundamentals, not emotions. Short-term trades require discipline. Long-term investors should avoid hype-driven decisions. Smart investors watch events, but they don't blindly chase them. Conclusion: the FIFA World Cup is a celebration of football, but for markets, it is a test of discipline. It creates winners in some sectors, temporary losses in others, emotional noise in the market. Understanding this balance is what separates speculators from smart investors. If you found this analysis useful, like the video, subscribe to the channel, and comment. Do you think sports events move markets more than we realize?